Okay, so that's me. I'm Nick Motson, currently AD for undergrad, so I look after all 4,000 of our undergraduate students and across the degrees. To give you a bit of background and to kind of put this into context of what I want to talk about, it's probably useful to tell you what I did before. So I was a student here, or there, actually over there, in Barbican it was in the days. So I did an undergrad banking degree. Wasn't a particularly keen student, I don't think. I didn't work that hard. My objective was to go get a trading job. That was all I was interested in at the time. And like probably most of you, I figured that my professors didn't know anything about that. I just needed the piece of paper to get the job. I was wrong in some ways. But anyway, when I finished, I did find a job. I started work at a small US bank or mid-sized US bank, First National Bank of Chicago, which was based in Covent Garden. I was a grad trainee. Started off on the short end desk doing money markets, forward rate agreements, forward foreign exchange, deposits kind of stuff. And I started in September. So I started in September 92, which is when we fell out of the ERM, which was an interesting time for interest rates. And I did a rotation on that desk, and then FX options, and then the long-term interest rates desk, so interest rate swaps. And they pulled me off the grad program. So within a year, I'd got my own book. I traded sterling interest rate derivatives, which is FRAs, swaps, government bonds, and forward foreign exchange, anything interest related. And I was there for about 4 years. Again, like most graduates, kind of figured, I know more than these people are paying me for. So I moved to work for the Japanese. I worked for Industrial Bank of Japan, which then became Mizuho at a later date. And while I was there, this is kind of the revelation that came forward to me, which was, at this point, I knew everything there was to know about finance as far as I was concerned. By this point, I realized there was so much I didn't know, and I really needed to upskill and learn more. So I went back to school. But I went back to school part-time, so I went to LBS and did an MSc in finance. My plan actually at that point in time was to leave this side of the world and move over into venture capital. That was a great idea in 1999 when I started, pretty terrible idea when I finished in 2001, because the dot-com bubble had burst and all the venture capitalists were out of work. But fortunately for me, Wachovia Bank poached me to run their trading group. And I ran trading for them for 3 years pretty much. Sounds much more important than it was, because when I joined, there were only 8 of us in the team. I got rid of 6 of those, hired new people. By the time I left, it was 12 people. And we covered government bonds, foreign exchange, FX options, interest rates, and interest rate options. When was it? April 2005, so Easter 2005, I resigned and I decided to come back here. And why make that choice? I mean, obviously I was relatively well paid. A few things happened. One was, this was possibly a bad career move. When I worked there, I was a grad trainee stroke junior. Well, I traded my own book, but still I was kind of treated like the junior to some extent. Didn't get paid desperately well, so I moved here for more pay. And when I worked here, you got a percentage of your profits as bonus. There was no negotiation. They charged you a large overhead every year. Once you got over that overhead, you started getting a percentage. Then you got a higher percentage, and they kept that back over 3 years and paid you a third of it now and kept the other back, and if you lost money, they took it back, so there's a clawback in place. It really taught me about risk management and trading. Moving here, I spent so much more time on management that I was less profitable than I was here. My salary didn't go up a great deal, and so ultimately I wasn't getting paid any more for doing this job than I was doing this job, and I was still in at 6:30, 7 o'clock in the morning, and because the Americans think the world's flat, they want to do meetings at 4 p.m. in Charlotte, North Carolina. So I was on the phone doing conference calls at 9 o'clock at night. I was in the States 1 week in every 6, and I got 1 kid on the way. Yeah, Edward was born in September. I got a kid on the way and sort of thought, actually, no, I'd already got one kid. I'd got one kid and I'd got another one on the way. And I sort of thought, well, there's more to life than this. And I'd put enough away that I thought, I'll go do a PhD. I'll go learn some more, because this taught me, I knew everything, wanted to know more, kind of enjoyed studying. I worked really hard at this. I think I missed one lecture in 2 years, and they were on Tuesday and Thursday evening, so it was always after work. And I wanted to learn more. And I was fortunate, I got enough money, my wife was supportive of me kind of broadening my experience, and doing that, I've been here now for, well, that's 20 years ago, isn't it? Once I'd finished, they took me on. I've done various roles here. I'm now a full professor. I do some research. I do quite a lot of teaching still. I do a lot of administration, because I used to run the masters and now I run the undergrad. And I do consulting as well. So it's a nice life. I'm never going to complain. I'm tired at the moment because you lot are a pain in the arse, and students cause all sorts of problems, as do academics. So it's not a relaxing job, but it's an interesting job. I see some value in it, but it does give me opportunities to do interesting things as well. So consulting on the side. I work with I only work with one hedge fund at the moment. I work with asset management companies. I worked on the LIBOR trials. I was expert witness for the plaintiffs on the LIBOR civil cases in the US. So I get to meet interesting people and do interesting stuff. And pay the bills, I suppose. When I'm not doing all that stuff, my favourite hobby is to try and kill myself. So not at the moment, as you can see, I'm carrying a bit too much weight, but I've done quite a few extreme triathlons. So Ironman triathlons, this is one in Norway. Once I got bored with that, I moved on to ultra running. So that's the Marathon des Sables. I've done that twice. Running across the Sahara Desert, that's Iceland, running across Iceland, so like 250k in 6 days, and kind of got a little bit into, I'm not going to call it mountaineering, but this is up on Mont Blanc. It's more kind of walking rather than climbing. I haven't got the coordination for climbing, and I'm currently learning to sail as well, so kind of like doing extreme stuff, which kind of ties in with the trader mentality. If I'm not taking risk on a day-to-day basis, then maybe I'll take risk otherwise. So that's me. I've obviously got a long experience. Before I talk about anything else, I wanted to put a disclaimer in here. This is what Dali presents as an old finance professor. I'm not going to give you career advice or investment advice. This is just what I've kind of learned over 30 odd years of playing around in financial markets. So, trading for other people, trading for myself, investing for myself, and a lot of research, because obviously I did my PhD and published research as well, and occasionally I have gambled. But the three things of investing, or gambling, trading, and investing, there are a lot of parallels, and there are a lot of differences. And some of the skill sets are similar, but some of them are different. And so I thought that was kind of a good thing to talk about. It's something that I've been thinking about putting together something for a while. So let's start with some definitions. Gambling is, good afternoon. Gambling is betting or wagering on something that's got a random outcome. You don't know what the outcome's going to be. You place some bet on that random outcome. The example here is the guy is playing roulette. Okay? So that's gambling. That's pretty straightforward. Trading is buying or selling, or opening and closing positions in some sort of financial instrument. Could be stocks, could be currencies, could be derivatives, could be cryptocurrencies, could be futures, could be all sorts of different things. What often these days the trendy thing is to talk about day trading as opposed to trading itself, but day trading and trading, same thing, just the time frames are shortened. And then the last one is investing, which is different from trading. So investing is buying and holding something for the longer term. If you're buying it and holding it, you assume that it's going to rise. So that is a given, otherwise you shouldn't buy it. I said buying and holding. I'm not saying it can't be active, but it's not buying and selling it on every single day. And that's the big difference between trading and investing. But let's try and dig into these a little bit more, because you might think, well, they're all pretty much the same. The objective of all of these is to make money. Whichever one you're doing, you want to make money. You could lose money. And in some cases, maybe more likely than others. What does make them so different? And that's kind of what I want to talk about today. So let's start off with gambling. There's 4 of you now. How many of you have ever gambled? The sensible one hasn't. Okay, so gambling. There's a random outcome, okay? How many of you, so you haven't, well, you might have done actually. How many of you have been inside a casino? Okay, in London, Vegas, Monaco? All of them? London. Okay, when you're in there, what do you notice?
No windows.
No windows? Yeah. No clocks. More often than not, the person loses, but that's an outcome. But when you're inside there, the environment that you're inside, so there's no clocks, there's no windows. Anything else? Free drinks. All right? But you only get free drinks if you're playing. That also, allegedly, they enhance the air with oxygen. That's allegedly. We can't prove that, but so, all of these things are there. Why? Why do they do that?
To make you more willing to play, get more money.
So they want you to lose perception of time. They want you to play more. Let's ignore the free drinks. They're not trying to get you drunk. You know, the point is that if you are sat at a table playing a game, somebody will come along and offer you a drink. It's just to keep you sat there. Why do they want to keep you sat there for so long? The more you play, the more likely you are to lose. Okay, what degrees are you all doing? IFRM, economics, psychology. Sorry? Political economy. Okay. How many of you did a quant module in year 1, term 1? Some sort of quantitative module. Central limit theorem? No? I haven't got a coin. You really kind of remember what it was, right? If I flip a coin, what is the probability of me getting heads? 50%, pretty much, right? If I flip a coin 10 times, am I going to get 5 heads? No, I mean, I could get 10 heads. That outcome is not going to be 50-50. If I flip a coin 1,000,000 times, am I going to get very close to 500,000? Very close, okay? So I can get 10 in a row, just if I do 10. If I do it 1,000,000 times, that 10 difference becomes smaller. And that's central limit theorem. As you sample something more and more and more and more, it converges to the odds, okay? And that's what casinos are doing. Because there is nothing to stop you walking in, and this guy's playing roulette, putting all your money on black, the wheel spins, it comes up black, you win, you walk away. You've won. You could bet again black, and it could come up black again. But if you bet 1,000,000 times, you will eventually lose. Or in fact, if you don't have to bet 1,000,000 times. But if you bet 1,000,000 times, it will 50%, just under 50% black, and just under 50% red. So they're playing central limit theorem. And all of the games within a casino, and any game of chance, I guess, but definitely within a casino, the house has an edge over you. It's a calculated edge. Doesn't matter what game you're playing, whether it's roulette, whether it's blackjack, whether it's fruit machines. You know, the fruit machine, somewhere on the machine, it will probably tell you that what the percentage payout is. And it'll be high, you know, it'll be like 90%, well over 90%. So they're not massively ripping you off, and it's not saying you cannot win. But on average, they will win, because they've got to pay for the building, the staff, the free drinks. Okay? And I'll take the example, you have seen this before if you did iframe possibly, a roulette wheel. So if you look at a roulette wheel in a European casino, there are 36 numbers, red and black, and there is one green 0. On an American roulette wheel, there are 2 green 0s. There's a 0 and a 00. And if you go to Vegas now, in some casinos, there's 3 green 0s. And if you play the game in one of those casinos, picking the European one is easier. If you put $100 on red or black, if it comes up the colour that you say, you will get $200 back. So you're going to double your money every time you're correct. However, because of that green 0, only 48.6% of the numbers are actually red or black. Because you could think, well, I'll put it on red and black. And I'll keep playing, I'll keep drinking the free drinks, and I'll never lose. But you will lose eventually, because the green 0 will come up. And so their edge is, you've got a 48.6% chance of winning. Their edge comes out as 2.7%. It's the same if you bet on a single number, because they pay you out 35 to 1, so you put down 1, you get 36 back. But it could, there are actually 37 numbers on the wheel. So they will always win eventually, or they will win in aggregate against all of the people that are playing. But that doesn't mean that you can't win. You play for a short period of time, you happen to bet it on black 13, it comes up black 13, you take your money, you run away. But people will continue to play, and ultimately the casino will make money. So if you gamble, in the long run, you will lose. In the long run. That's not to say you can't have short-term profits, but in the long run, you will definitely lose. Or will you? So this guy sat playing roulette. You have to be really stupid to play roulette. So out of you, you're the smart one, you've never been in a casino and not gambled. However, if you do decide, and any of you planning to go back to Vegas? No? I'm going back in November. Going for the Grand Prix. But yeah, I spent quite a lot of time there because one of my best friends lives in San Francisco. I used to spend a lot of time in Charlotte, North Carolina. It was a good place to meet for the weekend and then go home. So, and I quite like going there because it's entertaining. But if I haven't put you off, and if you are going back, the only game you should play in a casino is blackjack. And you probably know where I'm going with this, but if you play blackjack, how likely, so actually, have you ever played blackjack? So it's 21. The idea actually is not to get as close to 21. The idea is to get closer to 21 than the dealer gets to 21. And you have a choice whether to keep taking cards or to not take any cards. So you tap the table if you want another card, you go like that if you don't want another card. And they have to keep drawing cards until they get to 17. And then they stop. So if you've got 19, they've got 17, you win. But they can bust. They can go over 21, which means you automatically win. Your bets pay out 1-to-1, so you double your money on every bet. If you get blackjack, which is a 10 or a picture card and an ace, so you've got 21 with 2 cards, you get 3 for 2, so for every £2 you put down, you get £3 back, so you get 5 back if you put down 2. Although not always in casinos now, they've changed it from 3 to 2 to 6 to 5, no, hang on, 6 to 5. Yeah, 6 to 5, I think. They've cut the odds somewhat. Now, there is a way to play blackjack, which is called basic strategy. So you can memorize basic strategy. If you walk into the gift shop in a casino, they will give you can pick up a basic strategy card. It basically tells you that if the dealer has an up card which is any of these, let's say 2 through ace, so you get to see what their first card is, and you've already got a total of 17, you shouldn't take any more cards. Whereas if you've got a total of 11, whatever the dealer's up card is, you should take another card. There are other rules. You can split pairs. Don't want to get into too many of the details. But this mathematically is the best way to play any hand. And they will let you have one of those cards for free. And if you play basic strategy perfectly with no errors, the house edge is only 0.5%, which is tiny. Because if you think how much you can play, most casinos now, it's a $25 minimum per hand, so you play every hand for $25. You'll get through about 100 hands an hour if you're at a table with another couple of people, let's say. So you're betting $2,500 an hour, 0.5% of $2,500. On average, you'll only lose $12.50 an hour, which if they're giving you a free drink, is quite good entertainment. However, it's an average. And going back to central limit theorem, if you're only paying for an hour, the swings around that $12.50 could be very, very large. There's nothing to stop you losing 20 hands in a row. If you lose 20 hands in a row at $25, that's kind of upsetting. You're $500 down and you're thinking, I was only going to spend $12.50. So you really you could lose quite a lot. But on average, you will only lose that. However, you can take it one step further. If you've got, and I make this very clear, you need a lot of time, a decent sized bankroll as well, so you need fair amount of money behind you, and if your mental maths is any good, you can beat the casino on average. You can switch the odds to your favor. And if you've seen the movie 21, you will have worked out what the idea is. That movie is based on a book by Ben Mesrick. He's got two. One's called Breaking Vegas, and the other one's called Bringing Down the House. I can't remember which one's which. That movie is semi-true. And card counting is really easy. Any card that comes out, that's dealt out of the pack, which is a 2 to a 6, is good for you because it means there's more high cards left in the deck. Any card that's dealt that's a 10 through to an ace is good for the dealer because it means there's more low cards left in the deck. And high-low counting is very simple. You keep it in your head. You add 1 every time a low card's dealt out. You take 1 away every time a high card's dealt out. You ignore the 7s to 9s. And you divide it by the number of decks that are left because it matters how many cards are left. And if there's only really high cards left in the deck, that's massively to your advantage. This was proved by a guy called Ed Thorpe in the 1960s, when computers were relatively new. And the problem is implementing this. Because this is a very old Excel chart, but if you kind of look over here, if the count's 0, that is about minus 0.5%. That's the casino's advantage versus you. By the time the count gets up to 9, suddenly you've got like a 8% advantage. It's about 0.5% per true count increase. But even then, you don't win more than 50% of the hands. It's just the fact that you can get more blackjacks, which pay out at more than 2 to 1, and the dealer's more likely to bust as well. I say the problem lies in implementation. Why is there a problem in implementing this? We've just worked out that there's a system that you can walk into a casino and the odds can be in your favor. So why are you sat here? Why are you not all in Vegas?
They don't want the odds to be in their favor.
They don't want the odds to be in your favor, that's true. So if you go and try and play, what would be the optimal way to play this?
Bet a lot when you have a higher percentage.
So when you're over here, you want to bet loads. When you're over here, you want to bet peanuts or not even bet at all. Is that going to make you easy to spot? Yeah, they're going to see straight away. It's like, he keeps betting $25 every so often, and then suddenly he's betting $5,000 on a hand. So they're going to spot you, and they can say, I'm sorry, sir, madam, we'd rather you don't play in our casino. It's called being backed off, and they can stop you from playing. The other thing is that central limit theorem, you have to play a lot. Because even though the odds are in your favor, this is like saying, well, when you're over here, which is great odds, but that's like saying, I've got a coin that is 52.5% likely to come up on heads and 47.5% come out on tails. Would you bet a lot of money on the next one being heads? Well, you wouldn't, but if you could bet lots of times, then that would be good. So you need a bankroll, because the noise around the signal is massive, because they're still looking there. They can spot you. And how long do you think it would take you to learn perfect strategy perfectly? And then you've got to learn to count perfectly. It's hard. There's some great books about it. Go away and read them if you want to. But ultimately, the main conclusion is you're unlikely to make lots of money gambling. There are people who've won money gambling. That's great for them. There are also lots of people who've lost lots of money. But if you Google advantage players, there's lots of resources out there, freely available resources. You don't have to pay anybody. There's a really good book, which I think it's called This Blackjack Life, which outlines 2 people who did it. It took them a year to learn everything. And then they've implemented it, and it worked out quite well for them. But it's not an easy way. If you buy per hour pay, it's maybe not the best way. But you can do it. So that's gambling. So gambling's generally bad unless you've got some sort of edge. What about trading? So this guy's buying and selling something. We can split trading into discretionary trading or systematic trading. Discretionary trading is the trader's judgment to make decisions. You know, I think that stock markets are going to bounce today because they've had 3 down days. Or systematic trading is some sort of systematic rule. It's currently below the 200-day moving average, so I'm going to go short. Which one's best? If you had to pick, which would you pick? Sorry? A set of predefined rules? You like rules as well? You're not sure?
Depends. Yeah, is it for ourselves that we're deciding, or is it for...
Let's say, well, first of all, let's say it's for you choosing to invest with somebody else who's doing this. Would you invest with somebody who's doing this, or would you want to invest with somebody who's doing this?
If they're Renaissance or Citadel, of course I choose systematic.
Okay. So there isn't a right answer. Okay. However, I would make one thing very clear. One thing I didn't include on here is discretionary, systematic. What about proprietary trading is what I used to do, which is now illegal. Oh, it's illegal since Dodd-Frank. So I worked in what were commercial banks. They're not allowed to do proprietary trading anymore. I was investing and trading with the bank's money. So that's seen as probably rightly as a dangerous thing to do. And our trading was a mix of these 2 things. If I was to do it again, I'd probably say I'd go this way 100%, because there are problems with discretionary trading. So I think you said it depends on somebody's results. If I've seen somebody's results, then, but let's say for sake of argument that I bought Fartcoin 6 months ago, and it's now worth 8 times as much as I bought it for. Does that make me a genius? No, you're judging on what was luck, really. So I think There's problems with this one. This one removes one of the risks. And the big risk for discretionary trading is these two things. You're either ecstatic or you're miserable. Okay, he's making loads of money, he's losing loads of money. And his behavior will change according to that. And one of the big problems we have is behavioral biases. And if you ever go into trading or investing really as well, you need to kind of consider what these biases are. And some of the key ones are, one is anchoring. If I bought my fart coin, and by the way, I don't know what the price of fart coin is, but if I bought my fart coins for $1, that creates an anchoring bias in my head that I will only sell them for more than $1, even if the fundamentals have changed. You know, I know that fart coins are a scam, and it turns out, and it goes down to 25 cents, I should sell because I know it's a scam, but I bought it for $1, so I'm going to hang on. And we see people married to what we call married to positions, don't cut their losses because they've got anchoring. We also see massive overconfidence. I bought Fartcoin. That means I must know everything there is to know about crypto. One of my friends, business associates, whatever, he bought a chunk of Bitcoin at $100. Not like hundreds of thousands, but about 10 grand's worth of Bitcoin at $100. He sold it at $18,000. So he made huge amounts of money and thought he was a crypto expert. He wasn't, he just happened to get in on that one particular trade, and since then he's bought all sorts of meme coins and lost money. He's still very wealthy, so he's happy, but overconfidence is definitely a problem. So we've got anchoring, overconfidence, and somewhere in here is, where was the one I was looking for? Herding. No. Everybody else is buying Fartcoin, I better go buy some. You'd call it fear of missing out. Oh, FOMO. You know, these things have been known about for a long, long time. And there are very few consistently profitable discretionary traders. I'm not saying there are none, but there are very few. There are people who do well, there are people who do badly, but over a long enough time frame, discretionary hasn't worked massively well. I mean, I can pick out George Soros, spectacular returns, hit some really big winners, but then also had about 10 years of not doing particularly well. And he's a very, very clever man. So that's the problem with discretionary trading. The thing about systematic trading is it follows a set of predefined rules, which gets rid of you getting overconfident. You program them in to begin with, and you've decided that I'm going to buy Fartcoin when it crosses above a particular average or something like that, and then if it crosses below it, I'm going to sell it. And you're not anchored to previous prices, you don't become overconfident, so you can program up your computer to do it, and this has obviously become far easier over the last 5 to 10 years. Anybody armed with Python, an Interactive Brokers account, and some end-of-day data can program up to do that. So it does overcome the problem. Thing is, don't know if any of you do this, I do. How likely is it that an individual armed with a laptop, Python, and some data, not the best data in the world, but some data, is going to spot something that Goldman Sachs hasn't already spotted? They've got an army of people with great data who are probably better qualified than us. What are you going to spot that they don't? Or if I take a well-known hedge fund, Renaissance Technologies only hires people with PhDs in physics and maths and that kind of stuff. What are the odds that you are going to spot something and be able to perform or exploit something that they can't? Now, I will say later on that there are reasons why you might be able to. But it's not a given. And have you ever seen a bad backtest? If I give you some data, or if this guy started with some data, you go put some rule in place. I'm going to buy when it crosses the 200-day moving averages and sell when it closes below the 200-day moving average, and you test that and it doesn't work. So then you try the 100-day moving average and the 50-day moving average, and you try lots of parameters until you get one that works. And it works on your historical data. You go, I've got a profitable trading strategy, but you haven't. You've got something that fits the past. Then you've got to try it in the future, and it might not work in the future. The problem is that when you backtest, you are snooping history, and you're making something that fits history. And so you need to be able to move forward and check whether it actually works out of sample afterwards. But that's not to say it's impossible. Now, you are the social media generation. I can't open up, my daughter sends me TikToks. Usually they're about dogs and cats, by the way. But you know, everyone's got a Lambo, trading's easy. Subscribe to my channel, I'll give you FX trading tips and you can drive a Lambo like me. It's just absolute rubbish. It's not his Lambo, it's rented, or it's leased, or whatever else. It's not easy, and the reality is it's really hard. The person who lost everything by buying Fartcoin last week is not posting on social media saying how great they are. It's really hard. And one thing I'd say, particularly at this current moment in time, which is a great quote from Warren Buffett, is only when the tide goes out do you discover who's swimming naked. You have lived through the biggest bull markets in so many different assets. You know, equities have been going up, crypto's going up, bonds have gone down, I suppose, commodities have been going up. Whatever you bought 4 years ago, after the end of COVID, or when COVID, even before the end of COVID, but during that COVID period, anything you bought, you have had astronomical returns. So someone can say to you, look at all these returns that I've made by trading. But if they just bought it at the beginning and held it to the end, they would have made probably as much returns. So this last week has changed things a little bit. You know, suddenly we've had a massive sell-off, and there's lots of crying on, I use Twitter more than TikTok, but you know, there's lots of crying on Twitter of crypto people who've lost everything because it's all collapsed. So it is hard. And if you are trading without some sort of positive edge, it's the same as gambling. You need some sort of positive edge. The question is, how do you get a positive edge? Because otherwise, you're going to lose. Now, you might think that my conclusion is you're unlikely to make money trading and more likely to lose money. That's not my conclusion at all. There are edges out there that can be profitable. So in the same way as I guess you can look at going into a casino, you can play blackjack and learn how to count cards, then that works. In the case of trading, there are edges that are profitable. Exploiting them is not easy. So firing up Python and just following somebody else's rules is not the way forward. It takes huge amounts of time and effort to learn, and many of the edges that exist don't have lots of capacity, and that may be one of the reasons they exist. So there might be things that you can do as a retail trader, which isn't worth it to Goldman Sachs. You know, without being rude, if you can make $10,000, that's hopefully maybe a large amount of money to you. To Goldman Sachs, it's not worth worrying about. So small capacity edges are good. Risk management is vital though, and you need to understand, and I'll come to that right at the end, how risk management works. Because risk management is a bit of a misnomer. When risk management was kind of first invented by the quantitative finance people, it was thought of as to how to take sensible risk. Now risk management is thought of as to how to reduce risk. But what we're talking about here is we want to take some risk, but we want to know how much risk we should take. And a great example is going back to the card counting is the Kelly criteria. If you've heard of the Kelly criteria, what it tells you is If I'm given something where I've got a probability of winning, so if that's it's a coin that's biased, or if it's a blackjack game where I know my odds are in my favour, there is a percentage of my bankroll that I should bet, which will maximise my long-term returns. Or actually, it will maximise my long-term wealth, is what it will do, and it will stop me from going bankrupt. Because if I stood here and said, look, I've got a coin that's 60% likely to come up heads and 40% likely to come up tails, you're all going to bet on heads. But if I've given you $100, how much should you bet? You certainly shouldn't bet $100. You should bet somewhere actually around 20% of that. And then if you lose, you bet 20% of what you got left. And if you lose again, you bet 20% of that. And you will never run out of money. And the risk of ruin is large. And that has fed through because a lot of the advantaged players from the gambling world have moved over into finance at some point. So the great example is Ed Thorpe. Ed Thorpe was the guy who wrote about card counting, published it, did try it and made money doing it. He subsequently went on and ran his own hedge fund and various other investment funds. And there are loads of other people out there. So if you, Aaron Brown wrote a great book called The Poker Face of Wall Street. He was risk management for, well, he was a trader and then he was risk manager for people like AQR. So there are lots of those people. The same things apply. So this is the similarity between gambling and trading. It's about finding an edge, exploiting that edge, and managing the risk in a sensible way. So that's trading. What about investing? So you are the Buttonwood Investment Society, aren't you? So investing is buying or holding something. It's going to go up in the long run. So he's not particularly busy. You know what passive and active investing are. Passive is buying and holding something. Active investing is either market timing or security selection, or both. I'm an academic now, so you can probably guess I'm going to hate this and love this. Maybe, which is best? Well, I'm not going to ask you this. There's two main problems with active investing. The first main problem with active investing is the same behavioral biases. If you follow any great investors, some of them had fantastic returns for a number of years and then they look terrible. And what are the odds of you getting to the central limit theorem point where you've got the truth from their performance is relatively small. And one of the things I'd say is, there's very few who consistently outperform passive. I'm going to get back to Warren Buffett again. Warren Buffett has got a 70-year investment track record, 60-year investment track record maybe. Over the last few years, he has massively underperformed. Doesn't like crypto, hasn't invested in a lot of the AI type companies. However, if you go back to 99, 2000, again, he was being massively criticized because he didn't buy into a lot of the technology companies that subsequently then went bust, and then he was seen as a hero again. So it's like hero, zero, hero. As it stands at the moment, he published his update very recently. He's sitting on so much cash, waiting for something like this week to pick up opportunities because he thinks the valuations are too high. So there are people out there, but he doesn't come across as like this superstar investor. You know, he still lives in the first house he bought, drives around in a crappy car, drinks Coke, doesn't drive a Lambo, drink Cristal, and show off about it. But it's problematic because we don't know what people's track record is really, and there are significant costs to it. Academics will point out there's transaction costs which eat it up. There's definitely management fees if you pay somebody else to do it. But the other one's time. Time to actually make those decisions and manage investments takes a long time. Whereas passive, as long as you pick assets with positive expected excess returns, so in the long run they will provide some positive return, stocks for example, or bonds sometimes as well, you will make money. The only downside to it is, and looking at your age, is it can take a really long time. I mean, like a really long time. And I'll give you a personal example, which is I got not massive, but a decent bonus in 1999, and invested in stocks. I put it in some funds, bought them in 1999. Dot-com bubble burst, stocks down 30 to 40%. Eventually recovered to where I'd invested it in 2006, maybe early 2007. So invested in 99, it gets back to where I started in 2007. Then we get the global financial crisis and it goes down another 40%. And it didn't get back to where I started until about 2011. So 11 years, it started as a number, it's at about the same number 11 years later. That's a long time. If you can remember what you were doing 11 years ago, yeah? You were at primary school, maybe secondary school. However, now, another 14 years later, it's probably worth about 4 or 5 times as much. In fact, it's worth about 5 times as much as it was then. But investing is a really long-term process. You can't expect it to double every year. So, what can you do? I said I wouldn't offer advice, but I think it'd be rude of me not to say a few things. So, the first one is, I didn't actually say, you should invest. Right? Investing is the no-brainer. And there are also really good incentives for people to do that. So if as soon as you start work, bang money into your pension. You get the tax up front, you can't touch it, stick it away, because you don't want to work forever. What should you do? The first one is you should be a student of history. There's all these investing books, probably thrown 9/10 of those away. You need to understand what's happened in the past. Because history doesn't repeat, but it certainly rhymes. And I'll give you a few examples. There's one of the most read financy kind of books is a book called Reminiscences of a Stock Operator. It's written by allegedly Edwin Lefebvre. It's published around 1926 or something like that. It's all about somebody who was operating or was investing and trading in stock markets around the turn of the 20th century, so early 1900s, makes lots of money, loses lots of money. I'll spoil the end of the book. He shoots himself. And it's based off a true story. It is based off somebody. You can read more about it if you want to. Why is that relevant now? Well, stock markets weren't heavily regulated at that point in time. And they talk about things like wash trading, painting the tape, things like that. That's exactly what's happening in crypto markets at the moment. If you look at a crypto exchange, a lot of the trading is, I'm going to use the word fake. It's just to make the exchange look like it's got more volume than it has. The pump and dump schemes that you've seen with a load of meme coins where people rug pull it, that stuff was going on with stocks as well. So by seeing something that's happened 100 years ago, you can educate yourself about what's happening now. If you look back to the crisis we had in 1998, that was repeated in 2008, just on a much, much larger scale. If you look at stock valuations now versus stock valuations in 1999, you wouldn't be putting all of your money into stocks at this point in time. You would have some, because in the long run they'll go up, but the risk is more to the downside than to the upside. So history is well worth reading and learning about, and especially now considering what's going on in America, it's useful for you to kind of know how do tariffs play out with other countries and how has that worked for currencies and economies in the past. So definitely read lots, and I'll email you a book list. So you should read tons and tons of stuff. The other one is learn from other people's experiences. There are so many people who've made fortunes, lost fortunes by trading and investing. But don't mistake luck for skill. So don't just read about people that have been successful. Some of the best books to read about this, or best place to read about this, there's some of them are really old. I think the first one's like 92, but he published a new one last year, which is Jack Schwager wrote a book called Market Wizards. I think it was the first one in about 90-something. He wrote one called Unknown Market Wizards last year or the year before. Actually, maybe it was in COVID, so maybe it's 4 years ago. He's done one called Hedge Fund Market Wizards and one called New Market Wizards. Those books, if you read about the experiences of what people have done, most of the really successful traders lost money to begin with. A lot of them blew up, and some of them blew up once, twice, 3 times before they got it right. And those books are good because it's not just, oh, these people have done really, really well. You will not just mistake it all for luck because there must be some skill in there, maybe. So learning from other people's experiences, and if you manage to get yourself a nice job where somebody pays you to learn as well, that's even better. You know, that was a joy for me. Third one is, if you want to do any of this, you're going to have to invest a lot of time and energy and effort. It's not easy. Those edges that I talked about that are available out there, there's lots of academic research out there which will highlight those to you. I'm not giving anything away by saying, well, if you know that, you maybe don't know, but trend following works. It's not got a massively high Sharpe ratio, probably about 0.4, but trend following works. There's tons and tons of academic research out there which will show you that it works. If you read some books around it, you can replicate it. There are even books that will give you the trading system which will work. And that's a way to learn more about it. There's the key one where I've kind of been more successful is taking academic research and then trying to implement it. And you can try hundreds of different things and probably 99 of them won't work. But 1 or 2 of them will. Another one that used to work and doesn't work at the moment, there was a paper, if you look at commodity indices, they have to roll their futures every month, and they end up getting front run. So you know what's going to happen the next day in terms of the spread between 2 futures. You know what's going to happen when stocks get added and deleted from indices. So this stuff is useful. So reading stuff of SSRN is good. You need to understand risk management. Just because something makes money on average, it can lose a lot of money otherwise. I know certainly for one of my systems, I've got a thing that I run that's got a Sharpe, or has been running at a Sharpe of close to 2, but it had a 20% drawdown last May, which hurt. You know, you're making 6% every month and then suddenly you lose 20%. It takes you 4 months to make that money back. So you need to understand how much you're risking. If I'd taken too much risk, I could have been wiped out. And you've got to be realistic about what your competitive advantages are. So as you've probably ascertained, I am predominantly these days an investor. You know, I've got a nice pot of money sat behind me, which is sat there doing okay. I'm partially active because I think stocks are a bit expensive, so I've gone more into bonds than I had a couple of years ago. But a couple of years ago, when bonds were yielding 0, there was no point in buying them. So that's the main source for me. However, I still trade quite a lot of stuff, but it's all done automatically. It's all programmed up in Python. It sits on an AWS machine, so I don't even have to have my machine turned on at home. And most of my stuff closes out overnight as well. I don't tend to hold overnight positions because then that means I don't have to worry about it. I've got a job, I've got a wife, I've got 3 kids. I just want to be able to hit the button, spend a few hours a week checking that it's all okay and walk away from it. My competitive advantage is kind of 35 years of watching stuff and getting things wrong and knowing. I can kind of, I'm being kind of careful how I say this, because I'm going to say it the wrong way round. I can't forecast price moves, but I know the relationships between a couple of assets, what they should do over short time frames, given the flows that are going through the market. But I don't believe that I can forecast what stock markets are going to do. If I'd have spoken to you a year ago, I would have said, stock markets look a little bit overvalued here, and here I am a year later going, they still look a bit overvalued here, but they're a shitload higher. So I don't pretend that I can forecast, but you need to understand what your advantages are. And if you're going to do this, you're going to have to get your hands dirty. There is no better lesson than losing some money. The example that I just gave, that 20% drawdown that I had last May, I realized I was using too much leverage in that system, so I reduced it. It was a painful lesson to lose. It's so easy to open. No pitch, but I would recommend Interactive Brokers is great because it's got a Python API. It's got third-party APIs. I don't actually use their in-house one that are really easy to use, simple to program up. I'm not a programmer, but even I can do it, so it can't be that hard. And you learn so much, and you do need to get your hands dirty. Just doing it on paper is not going to teach you everything. But again, the nice thing about brokers like them these days is there's a paper account. So you can open an account with a few $100s. I don't know what the minimum is. And then you can use the API and trade on a paper account where they put $1 million in it, and it doesn't matter if you lose. So that one is key. And then the last one is you need to be an investor as well as a trader. There's no, even if I look at some of my very, very, very successful trading type friends, by the time we reach our age, probably the bulk of our wealth comes from being an investor. That's not to say that some of that invested money or a large part of it didn't come from trading, but this one is key. And once you start work, start putting some money away, and then that's always sat there, but keep some aside. And I'm trying to think about mine, I've probably got, is it 80-20? It's not quite 80-20, but probably 80% of my money is invested and 20% of my money is traded. And there are no shortcuts. This is hard. If I think back to some of the stupid trading decisions that I made at different points in my career, I lost money both from my employer and for myself at various points. It's not easy. However, I guess in the long run, I definitely made money for all of my employers, and I've certainly done okay for myself. I think that's it. Oh, I did say an hour. There you go. Q&A. Questions? Yeah.
What are you invested in right now?
What am I invested in? Mainly passive. In fact, on an investment portfolio, 100% passive. I'm now 50% equities, 50% fixed income. And mainly short-dated fixed income, so sub 5 years. I'm 55 years old. I'm probably not going to be working that much longer. If we go back to 5 years ago, 100% stocks. But now, yeah, I took a lot of risk off the table in October, November, December. I don't try and get clever about that. There's two things. One, I don't want to spend time doing it because I don't find it that exciting. But two is, I know, going back to my competitive advantage, I have got no idea where this stuff's going next. Stocks could be up 5% today. I'd have no idea. I can't predict that. What I can predict is I've had spectacular returns since 2021, even if you take into account the 1 year that it was down, higher than I expected that I would get. So do I expect those going forward? Probably not, which is why I reduce the risk. And something like a batshit crazy American president coming into power, who knows what's going to happen next? So it kind of made sense for me to reduce risk. If I was 21 again, I'd probably have more in stocks, but at this point in time, maybe not a huge amount more, because I think there will be opportunities to buy it cheaper, just on valuations. But that can be horribly wrong again. I would never bet against a bubble. If you go back to 99, 2000, the NASDAQ, I think, doubled in a 3-month period at the end of 99, I think it was. And all the people who tried to fight that bubble by going short it blew up. They were right, they were just too early. I'm not playing that game. So I just passively invest. My net cost is 16 basis points per year. And that's enough for me to pay in fees rather than paying an active manager 2%. Anything else?
Yeah. Do you have a favorite investor and a favorite investment book?
Ooh, that's a good one. In terms of, so favourite investment book, so did I open it? I might have opened it. I will email this to you. I think I shared it with the class on the module I was teaching this year. I update a book list every year. So this is 10 pages long of books. I read incessantly. In fact, now I generally use audiobooks rather than reading actual books. In terms of favourite investment books, I can't name one. However, I can give you probably 3. In no particular order. In terms of the hedge fund space and how kind of a lot that came to be and how they think about it, there's a great book called More Money Than God, which is written by Sebastian Malalaby, I think. Yeah, More Money Than God. So More Money Than God, I think, is a fantastic book. It's 15 years old, but probably just as valid today as it ever was. So More Money Than God would definitely be a favourite in terms of kind of historical, how an industry came about and how things like risk management are mentioned heavily in that book and how they decided how much to go long and short of various things. So that's a really, really good book. Another one is Expected Returns by Antti Ilmanen. Antti Ilmanen's an academic, but works at AQR and has published all sorts of research. He wrote a book in 2011 called Expected Returns. It's got some really simple trading strategies in there, but they're kind of like, why should you expect to get a return from trend following? And then he actually gives you the returns. So he shows how it's done and things like selling volatility, why that might work sometimes and not other times. So it's really, really well illustrated. So that's kind of like a reference. I think I call that section reference. Reference. I would always recommend that people read that. And then the other one would be Reminiscences of a Stock Operator, which is not there. Is it there? Greatest trade ever. Can I do a search on here? I can. Oh yeah, General Trader. 1923 was published. This book's fantastic. Definitely, and it's actually about Jesse Livermore. There's another book about him called The Boy Plunger. That was published a lot later. But this kind of shows you the life of a speculator and the highs and the lows. And yeah, it's a really. But there are some fantastic books out there. But I'd say there were the 3. If I was feeling really bored, I'd read Liar's Poker. And he recently re-released this. This was never done as an audiobook, but it's now available as an audiobook, and it's him narrating it. He does some podcasts as well. But yeah, I'll email you the book list after today, and you can wade your way through it. In terms of favourite investors, oh God, I don't know actually. That's a good question. I mean, I find the story of Renaissance Technologies, or Rentec, fascinating. Jim Simons, his idea was really, really smart. It's like, let's take maths and signal processing and pattern recognition and apply it to financial markets. And the way in which they've done it is just incredible. So I would say he was one, and similarly Ed Thorpe. I think Ed Thorpe's biography, it's an autobiography, is also really good because Simons has made billions, also did some dodgy tax stuff and all sorts of other things. Ed Thorpe's very ethical. Now, he's still married to his first wife, although she's not actually, she passed away, unfortunately. But he was married to his first wife until she recently passed away. He still teaches at university, still will speak to anybody who wants to. So I'd say those two probably, because I do err on the quantity side, not on the seat of the pants trading stuff. But I like Warren Buffett still. He's entertaining, and him and Charlie Munger have done some incredible things. But if you look at their returns, it's predominantly that they had a huge bankroll. So they've got this. You've got an insurance company which rolls in cash every year, and access to leverage, and basically you can explain his returns with leverage and the value factor. But yeah, the other two, Thorpe and Jim Simons probably. Yeah.
Where do you think the hedge fund industry is sort of going? Do you think it'll shrink or active investors?
Yeah, so okay, that's a really timely question. So the hedge fund industry has changed dramatically in the last 5 years, I would say. So the traditional hedge fund industry, well, actually, it's gone through a cycle. So traditional hedge fund industry was single manager hedge funds. Someone charges 2 and 20. They've got some sort of system, whether it's discretionary, automatic, whatever, automated, whatever. They follow a strategy. You invest with them. That's fine. And then funds of funds would sit above that and channel the money to those people, or it'd be high net worth individuals. And then, of course, people realized funds of funds charged fees that were too high. And then a massive growth area the last 5 to 10 years has been multi-manager funds, multi-manager, multi-strategy funds. And that's where I think the shakeout is going to be. Because those funds are built around allegedly really strict risk management. So I sit there at the top, and I'll pick Millennium as the example. I sit there at the top of Millennium, and I have all these pods that are independent from each other, and I give them all 100 million each. But I'm using 10 times leverage in order to give them 100 million each. And if their stop losses are really tight, if they lose 5%, they're closed down. And I think that those aren't all highly correlated to each other, and etc. Markets like we're seeing this week are really testing that model. You hear nothing but rumours that a pod somewhere has blown up, and that's why we see these sudden moves in certain stocks. And if you look at some of the obvious long shorts that people were doing, they're just blown out of nowhere because all the shorts are having to get covered and all the longs are having to get liquidated because the risk tolerance has gone up. My guess is that hedge funds are in for a tough few years. My guess is that somebody will blow up, or not lose all the money, but lose a fair chunk of money, and that will cause another shakeout in the industry, and the large ones will survive and the poorer ones will do poorly. If you look at some of the ones that have historically done well in times of crisis, the Brevin Howards of this world, I think they will continue to thrive. They'll probably continue to manage $30 billion. They're happy. They're charging 2% on $30 billion a year. But I think this multi-strat, multi-manager model will be severely tested. And same with pass-through fees and things like that. I'm happy. What I care about is my net returns. So going back to what am I invested in, I care about my net returns. If I'm going to buy a bond fund and I know that I'm going to earn 4% a year, I want to pay 5 basis points in fees. I don't want to pay 2% in fees because I'm giving half it to the manager. In the hedge fund space, that one's key. people don't mind paying high fees as long as they're still getting high returns. But if those returns start to fall, they'll evacuate, and that will be the end of some of these funds. So I think there's a big shakeout on the way. Yeah, I wouldn't be looking for a job in a hedge fund at the moment. Yeah.
A bit of an unethical question, but what do you think about war companies, and do you think they're safe?
What do I think about?
War stocks.
War stocks.
That's a bit of an unethical.
Yeah, I don't know on that one. I mean,
Are they safe?
I'll be honest, I don't have a strong opinion. I don't have a strong opinion. I think I don't think any stock's ever safe. If I was looking for safe stocks, I'd be saying utility companies. You know, water, electricity, gas, etc. But again, that depends on where you are. So if you look at the UK, we've got a water company that's going bankrupt. Why is it going bankrupt? Because it was owned by private equity. They've extracted all the value from it. They paid themselves dividends, borrowed, leveraged it up, and not invested in the infrastructure such that it gets fined by the regulator and everything goes wrong, and the public ends up picking up the cost. However, if you were to invest in US utility companies, I'd say that was relatively safe. In terms of, when you say war companies, if you mean defense contractors and arms manufacturers, their returns tend to look like that.
Overall, the general trend is that
Yeah, because the world has become a more unstable place. But if it came out tomorrow that a ceasefire has been agreed in Ukraine, and that Donald Trump's removing all of his tariffs, and under the ceasefire in Ukraine, the US is going to help patrol a demilitarized zone or something like that, suddenly those stocks are going to go like that. So I don't have a strong view. It's kind of like trying to forecast the politics going forward, and trying to forecast what's going forward in the world at the moment is just crazy. The way I always like to try and think of it is that if you step back a year, would you have imagined where things are now? If I'd asked you a year ago, where's Bitcoin going to be? Where's Ethereum going to be? Where is, I suppose, where's Nvidia going to be? Where's Meta going to be? Who's going to be president? Is the war still going to be ongoing in Ukraine? What's going to happen in the Middle East? You wouldn't forecast any of them correctly. And I think trying to say that you're going to do that the next year is a dangerous thing to try and do. Yeah.
Do you think there's still edge in fundamental research in the sort of small to mid-cap segment where institutions and hedge funds really aren't nimble enough to enter and exit positions, like the, say, sub $2 billion market cap segment where you don't really have a lot of institutional players except for index funds and passive holders?
Did you come to Martin Taylor's talk?
No.
No. Okay. So I've got he's not a friend, an associate. So there's a guy called Martin Taylor. He runs, I can't remember what his new fund's called, Crake. So Martin Taylor used to run a fund called Nevsky, and now runs a fund called Crake. In those Market Wizards books, he's featured in the Hedge Fund Market Wizards book. He still runs Crake. So what he did was he retired in I think he retired in about 2016, 2015. Closed his fund down. He didn't lose money. He just decided he was going to give up. Retired. He's the same age as me, so he'd have been late 40s. Took a couple of years off, got bored, relaunched a new hedge fund. Immediately raised 1.6 billion in 2019, 2020, and he's doubled their money since. More than doubled their money. He's averaged 20% a year over a 30-plus year period, and he does it predominantly by fundamental stock picking. So it'd be foolish for me to say no. So I think there is. Could I do it? No. Can everybody do it? No. But I do think there is space for that out there. I don't think markets are efficient. I think there is things that people can do. He doesn't allow it to be recorded, but one of his big things is if you ask him how he outperforms, one is he's right less than 50% of the time, but when he's right, he's really right, and when he's wrong, he cuts it. And he's always looking for a catalyst. So what he's looking for is companies that they think will beat their earnings forecast for the next 4 years, which will lead to a stock price increase. And he avoids, there's no pen, but stock markets, what most people do is they watch stock markets do this and they buy them when they've been going up. And then they go down and they sell them. And he avoids that. That's one of his key ones, is not going with the herd and avoiding a lot of the behavioural biases that I talked about earlier on, is he thinks one of his key added value. Then there's the fundamental research, and he hires people to work with him who do the fundamental research as well as him, and then the sizing of the positions as well. So I do think there is space for that. It's not a skill that I've got. And possibly those opportunities have maybe got bigger with the rise in passive investing, because there's less people investing money in stock picking. So yeah, there probably is. The question is, I'm going to say this without being rude to him. If I look at my long-term investing portfolio, probably averaging 9 to 10% a year, which is higher than it should be. I think it should be more like 6, but I've had a nice run up. I could invest a lot of effort and maybe get that up to 15. He's up to 20, and he's fantastic. He's in the top 1% of performers. I've got different stuff that I can do. Like I said, if I look at my trading portfolio, where I think there's a Sharpe ratio of 2, and if I'm willing to accept 25, 30% vol, I can make 60% a year off that. If I'm willing to take 10% vol, I can make 20% a year off that. So I put my efforts elsewhere. But it's only small capacity. I certainly couldn't manage 1.6 billion. I would say some of the strategies I use